Okay, investors, over the last 4 weeks, our team has released our thoughts on 2026 and what might be in store for the equity markets. If you've been watching our content, you'll know that our team remains constructive overall for equities for the total of 2026. However, we are expecting a heightened level of volatility in the financial markets, particularly in the first half. We titled our overall outlook, "In some years, it's harder to ride the bull." Given my love of 80s rock music and bands, if we had a theme song for 2026 outlook, it would probably be Patience, the 1988 hit by Guns N' Roses. Why? Well, Patience is a rock power ballad with navigating a difficult relationship, emphasizing that love requires time, understanding, and calm, taking it slow sometime approach for things to ultimately work out. Man, that sounds to me like a great recipe for investing most years. Sometimes, on rare occasions, it's better to act fast and put more dollars to work aggressively and walk away, and the stars align. The investment opportunities abound, the odds for higher than historic returns are in investors' favor. As we've discussed in our previous videos, we don't expect the beginning of 2026 to play out as a move fast to invest in markets. Here's a repeat of the great data from Charlie Biello on the annual drawdowns and their frequencies in the S&P 500. Look at the above chart. Minus 5% declines in the S&P 500 happens nearly every year. Minus 10% declines happens every 18 months. The last decline we had, over 6%, was back in April of 2025. Those bear market declines of minus 20% happen a little over once every 4 years, while recessionary declines of 30% happens 1 out of 10 years. What issues, as well as what opportunities Yield Harvest investment team thinks the coming year might present investors? There are times when tactically investing odds favor going fast and investing more. There are other times, like going into 2020, it was time to curb your enthusiasm and proceed more cautiously. Our team is thinking 2026 will likely be one of those more volatile years. We listed our 4 reasons for the non-linear 2026 in our last few videos. Let's review them again. First, it's the second year of a presidential term and a midterm election year. The gains in president's second year from 1940 through 2024 period per Merrill Lynch has been only 4.22% net, less than half the average annual S&P 500 gain of about 10%. Remember, these are point-to-point returns at the start and end of the year, and they don't include intra-year highs and lows. That is, they don't include volatility throughout the year. Here's Merrill's data set. You'll notice, in addition to the lower overall returning years, historically, almost all the net gain of the year occurs in the fourth quarter. Besides the midterm presidential election cycle in 2026, historically, the market has had a history of testing a new Fed chairman during the first term. Investors should be wary of late first quarter and second quarter of 2026. What am I talking about? President Trump is looking to nominate a more dovish Fed chairman as Powell exits in the first half of the year. While this is likely to be bullish longer term for equities, it doesn't guarantee a smooth ride during the year itself. The chairman is just one vote, and while they have sway, they don't cast votes for others. Historically, the markets test the new Fed chair early in their terms. Here's a list of recent FOMC chairs and what happened during their first 12 months in the lead. Lots of negative peak to trough numbers in that data set. A new, more dovish Fed chair would likely be cheered by the markets for a while. I don't think it'll be a straight line up in 2026. That likely more would be a second half 26 timing. Another headwind in the first half could be a seasonal uptick in the inflation numbers here in the U.S., as an uptick in market inflation expectations in the early months of the year seems to be likely. As we've discussed before, inflation ratings in the U.S. tend to be quite seasonal, rising in the first quarter and slowing the rest of the year. Concerns over catch-up effects of goods tariffs and higher New Year labor costs and stratospheric medical costs increase could investors and consumers slow down just as investors begin to worry about Fed independence under a new chairman in the first quarter. Lining up for a stronger mid-year move in the market is the progression of earnings in the S&P 500. Currently, FactSet data has EPS forecast for the fourth quarter quarterly earnings expectations of about $18.50 per share, up over 17% year over year from the fourth quarter of 2025. Remember, investors over longer time frames, stocks follow earnings. And historically, unlike market bottoms that anticipate recoveries, the market doesn't historically peak in front of earnings, but rather coincidentally. As one can see, there will be big pushes and pulls in 2026. One of the things that's top of our mind for our investment team is sustained heightened market volatility throughout most of the year. And with that, the need for investors to have a little patience, at least a little more than in most other years. Keep following our investment content on our Oak Harvest website and our YouTube channels, and we'll be addressing more of our outlook in the next few weeks. And tune into our live stream on YouTube with Troy, Charles, and myself, and our 2026 market outlook on January 29th of this year. Investors, whether 2026 plays out to be a bulking bull ride or something different, the entire Oak Harvest team is here for our clients, doing what we can to plan for you, your family's future, regardless of what stage you're at in your career or in your retirement.